Good afternoon. Welcome to the latest edition of NextGen Treasury. My name is Oscar Johnson. I'm the U.S. Head of Sales for Treasury and Payment Solutions at BMO Commercial Bank. For those of you who are new to our quarterly NextGen series, our aim is to deliver great content and ideas on topics that are timely and relevant to you. NextGen also provides you with the opportunity to receive CTP credits for attending each educational session. To date, we've covered topics ranging from liquidity and cash to cyber fraud and AI. Today, my colleagues will be discussing a very timely topic: how to manage FX and rate risk in the Trump era. With that, let's begin.
Thanks, Oscar. Good afternoon, everyone. Welcome to the latest edition of NextGen Treasury. My name is Dean Gillis. I'm the Managing Director and Head of Global Trade in Global Transaction Banking at BMO, and I'll be your host today. As Oscar said, our aim with this series is to deliver great content and ideas on topics that are timely and relevant to you. Now that the new U.S. administration is in place, few can argue that the policy changes that it promises are on top of everyone's mind. We acknowledge this is a politically charged time, and our role in this discussion is to help interpret some of the communications based on the current facts. You can appreciate if we had the NextGen Treasury virtual event yesterday, we'd be having a very different discussion. During his presidential campaign inauguration speech, President Trump promised significant changes from the last 4 years across a wide range of policies. As he begins his second term, he has already made immediate impact on his campaign promises with announcing potential tariffs on goods to U.S. trading partners. So here we are. What are the keys to successfully navigate the shifting trade dynamics and economic policies in the short and longer term? It's focusing on managing interest rate swings, foreign exchange exposures, and trade risks. Today, my colleagues and I will be discussing the recent news and how to manage it and how to manage the volatile markets. We'll explore how the U.S. administration proposed changes may impact operational cash flows, balance sheets, and hedging strategies, and discuss practical solutions to stay ahead in this rapidly evolving environment. I'm joined today by two of our BMO subject matter experts. I'm sure they've had very little sleep over the past few days with the emotional whirlwind on the tariff announcements and the subsequent economic analysis of the trade and foreign exchange impact between the countries and their ripple effects. Jennifer Lee is the Senior Economist and Managing Director at BMO. She has a strong reputation for her thoughtful analysis on the U.S. economy, as well as her commentary analyzing financial markets and economic activity in Europe and Japan. Welcome, Jennifer. I'm happy to introduce Stephanie Petti as Director of Corporate Sales and Structuring at BMO. Stephanie works with BMO commercial clients to develop and execute strategic risk management solutions to help manage foreign currency and interest rate exposures. Great to have you here, Stephanie. Our conversation will start with the economic outlook, followed by managing FX and rate risk. Now let's begin, as we have a lot to discuss and digest. Jennifer, why don't you walk us through the macro view of what we are seeing?
Well, hi there, and thank you everyone for spending your afternoon with us on the 4th of February. So I'd like to say that or like to think that the events of the past few days were a great example to sort of expect the unexpected, to sort of, roll with the punches and stay limber and stay flexible. And this is certainly the new environment. We need to expect this with the new administration. I'm going to quote the ECB's Olli Rehn from Finland. He said this morning that this is not only about economics, but this is also about politics. And I think that's very true. So yours truly has been wishing for clarity, and I think we have it, or maybe we had it. I'm not even sure right now what we have now. But let me just, I'm going to just humor me and let me just go through the timeline briefly. It was Saturday, February 1st. The executive orders were signed. 25% tariff on Canadian imports going into the U.S., 10% if we're talking about energy, 25% for Mexico, 10% for China, and those all effective February 4th, which is today. So that was all invoked under the International Emergency Economic Powers Act, or the IEEPA. And that's because, of course, the border crisis with the illegal migrants and drug crisis with a flow of fentanyl. Now, even though Canada and Mexico were granted 30 days of breathing room or a pause, there has been damage done. They're all think about all the scurry of activity that happened in the lead up to all of this. Calls for exemption. The U.S. aluminum industry did it right away on Saturday evening. The auto industry wanted a carve out. The energy sector, even the United Steelworkers Union said that lashing out at key allies such as Canada is not the way forward. Of course, there are a lot of wheels in the legal world being all being turning in progress because everyone was like lawyering up, and there were lots of detailed lists of retaliation measures, and they had to be detailed, right? Because trade with the U.S. is a big deal. Now in Canada. Canada imports $375 billion worth of stuff from the US, which is about half of total imports. 40% of those imports were going to be subject to tariffs, like 155 billion. So we're talking orange juice, and yours truly loves her orange juice, peanut butter, beer, coffee, wine. Yours truly loves her wine, all that sorts of stuff, appliances, clothing. And of course, the second round would be like cars and beef and pork and all those sorts of big ticket items. Now, Mexico was reportedly going to have a carousel retaliation, which I thought was kind of an interesting concept. It means that they're going to sort of rotate or change up what was being tariffed in order to keep the U.S. on their toes. Now, none of this had to be done, thankfully, because of lots of negotiations, and a deal was made. And a short term deal it was, but a deal nonetheless. That in itself, I think we all agree was good news. But if anyone thinks that this is it, I think that is probably going to be the wrong thought. We've got China still out there. They have a 10% tariff now in place. China has also retaliated, although the moves were a little bit modest. Starting next Monday, I guess, on February 10th, there's going to be a 15% tariff on things like LNG and coal. That's going to kick in, and then there's going to be a 10% levy on things like farm equipment and crude oil, auto pickups and things like that. And then there are going to be export restrictions as well on some rare earth minerals. So the big question, I think, is going to be like, how is the U.S. going to retaliate? Is the U.S. going to retaliate against these retaliatory measures? And so that's the question. It's like, what is next to follow? And I think all trading partners should be very nervous. I used to say that it used to be only those that are running surpluses, but I think it's anyone that has traded with the U.S. should be pretty nervous. They've already threatened the European Union. I don't know who's next, if it's going to be Japan. They mentioned the UK, although President Trump did say that they might be able to work things out. Vietnam is another example. But I think this is just the beginning, and even with these 30-day delays. And then there's another deadline coming up, by the way, April 1st, and that's when President Trump has ordered some federal agencies to look into all these other different countries that the U.S. does trade with to see if there's anyone that has, a persistent trade deficit, if they are any countries that have unfair trade practices, or if there's anyone that's manipulating their currencies. Are they holding them down? So, by the way, it's also interesting that they mention that because the U.S. Treasury also has their semi-annual report on currency manipulation, and so far no one on that list has officially become or been labeled a manipulator. So we're going to have to see how that changes. But I think at the end of the day, we should be expecting more tariffs. It's just unclear, as I like to call it the W5, the who, what, where, when. Well, we know the why, but more like the how.
I appreciate the insight. But this is coming when Canada's political leadership is also in question. Bad timing, isn't it?
Oh, very, very bad timing. It's very unfortunate. Of course, it's never going to be a good time. But right now with Canada, we don't have an official leader. We do, Prime Minister Trudeau, but he has stepped down, and we are now in a leadership race. So, Canadian Parliament is prorogued until March 24th, and even though we have a big push from the Conservatives to return early to deal with everything, I don't think that's going to happen. So, the Liberal leadership race, again in full swing. It's basically between two players, Mark Carney, who was the former Bank of Canada governor, also was the Bank of England governor, and of course Chrystia Freeland, who used to be the deputy prime minister. So the Liberal Party will decide between those two who is going to be the new Liberal leader on March 9th. And what will follow is likely going to be a no confidence vote. And assuming that the Liberals lose, and that's a big maybe, but you never know. So assuming that the Liberals lose, then we're probably going to have a spring election. And if they don't lose, then at the latest, the next election will be in October. So it's basically either going to be spring or in October. But in the meantime, the government is still operating in terms of these global issues. Everything that we've been hearing about is still operating, but any fiscal measures that the government had mentioned during their last budgets is probably on ice. So, of course, the lack of leadership is just very, very bad timing. And this is, by the way, a situation that we're seeing around the world. In Germany, they had the coalition government collapse, and now they have an election coming up on February 23rd. In Norway, one of the wealthiest countries in the world, their government collapsed last week, which was a bit of a surprise. Even in France, like right now, there looks to be a little bit of stability, but they've got their fourth prime minister in the last year. So that's like a lot. So all this is happening as this political tornado is ripping across both sides of the border of the U.S. It's ripping across the Pacific, and it's about to come tearing across the Atlantic. And I feel like it's almost like whack-a-mole, right? You're trying to deal with everything domestically, and you're trying to deal with all your other stuff on the international front. So this is what's happening. So while all these other countries are sort of I don't want to, I don't know if I can say fiddling and burning. The leader of the free world is basically doing almost everything that he said he was going to do during the campaign trail. So we cannot be too surprised. So again, humor me. I'm just going to kind of recap what he did on the first day. He signed a lot of executive orders. He dealt with immigration, sent thousands of troops to the southern border to seal it off, and kicked off this massive deportation effort. And now now the U.S. has help from Mexico and Canada. Um, he also dealt with clean energy, walked back a bunch of President Biden's EV mandates, and he plans to increase fossil fuel development. He blamed energy for the run up in inflation. So they're going to quote drill baby drill. That's the idea. I believe they're still setting up the ERS, or the External Revenue Service, just to collect tariffs. I'm not really sure if he has the authority to do all that without congressional cooperation, but anyway, we'll see how that pans out. And of course, manufacturing. He wants to bring a lot of the manufacturing back home to the U.S. So back to the tariffs. Yes, it was we had some relief because it was because of that 30-day reprieve, but I think we felt relief before, and it was short-lived. So I just want to give everyone out there some facts. Majority, if you think about this, all the majority of all U.S. exports go to Canada and Mexico. 33% of all exports go to these two countries, and those exports cover over 70% of all export categories. So it's very broad. 7% of those exports in total go to China. So the bulk of it definitely go to Canada and Mexico. Some Canadian facts, three-quarters, 75% of all of our exports go to the U.S., and roughly half of everything that Canada imports come from the U.S. So there's a very trade is obviously very, very tightly linked. And of course, it differs by province and by sector. Now, President Trump also mentioned the EU. That's next on his list. He mentioned the BRICS. And again, anyone, I think, with a trade surplus or any kind of trade with the U.S. should probably be a little bit nervous. And just like what happened with Colombia, threatened with 25% tariffs, and that lasted. Well, it didn't really go into play, but the whole threat lasted about a couple of hours. So I think we got to give the Trump administration marks for efficiency and speed of just getting a lot of the stuff through. We're barely in through the first month of this administration, but they basically hit the ground running. There are people with a mission. Look at Marco Rubio. He was passed, and all of a sudden he's on the phone with Vietnam discussing trade deficits. So again, things are moving along. He doesn't want to waste time, and just trying to get a lot of the stuff done over the next few months. So, I don't know, but I'm curious of whether or not Doge is learning from this.
Thank you, Jennifer. That certainly was a lot to digest. With all these things going on, what are the implications from the tariffs or lack thereof in the short term or in the next few months? Why don't we start with the U.S.?
Okay, so implications. Well, a lot of moving parts, and which I think everyone can appreciate. I think most of us are glad that we didn't see that blanket tariff that was first threatened that would cover all $3 trillion worth of imports. Although confidence has been, to do a James Bond thing, has been shaken and stirred. But it was interesting that even the quote unquote moderates, and I'm thinking about Treasury Secretary Scott Bessent, weren't able to shake him, and he was the one who was pushing for a gradual rate increase. Or maybe he did. I don't know. I'm not there. So, but I think the risk that is higher now that a tariff will be used for non-trade reasons. So the implications of all this, Mexico and Canada obviously won themselves 1 month's time, 1 month's reprieve, sending troops to the border, and that's a positive for both. But I think again, confidence has been shaken up. So we're wondering sort of what's next, in the next 30 days or April 1st, as I mentioned, with those findings of the trade situation. And of course, now we're going to focus on the next country besides China, and EU right now has been named. But in terms of implications for the US, certainly I think a positive for the US economy that these tariffs were not going into place, because they're basically quite broad based and comprehensive. And they hit, again, the biggest three trading partners of the US, which is like 40% of all of these US goods imports. Now it's just China, by the way, and they account for, just I'm going to say 13%, but that doesn't include countries that China is going around just to get into the US, but 13% directly from China. So what would have happened? Let's just say, humor me, like what would have happened if we actually saw those tariffs come into play? We would have had immediate supply chain disruptions in a number of industries, and cars is probably the easiest one or the most obvious one to think of right now. You're probably going to see shortages of some products in the stores. You would see probably a near term price spike for a lot of these imported goods from these countries, again, because these are the US's largest trading partners. You would have seen a lot more, I think, financial market volatility, just as markets are trying to figure out this ever-changing, macroeconomic landscape, and ultimately we would have seen lower growth, which is all just because of all the tariff increases and the retaliation. So we had, notice the past tense, we did lower our GDP growth forecast for this year and next, but right now we're going back to where we were, which was before this happened, this weekend occurred, which is roughly 2.4% for this year and just 2% for next year. But obviously, as we can all fully appreciate, things can change very, very quickly. Could get worse, they could get better. It just depends on financial market responses. It depends on how central banks are going to handle this. It depends on how the government's going to handle these things. And I will also like to mention that American consumers, by the way, would have also felt the pain of just the pain of the inflationary impact. They would have seen prices rise. I don't know if it's going to be immediate because I think there was a lot of stockpiling ahead of all of this. We saw businesses, again, inventories rising. We saw imports rising ahead of this potential, all these potential tariffs that everyone knew about it for months. There's also that potential port disruption as well. So you saw people, again, businesses stockpiling. So how long those stocks are going to last for, remains to be seen. But I think U.S. importers would have borne the initial higher costs, and then they would have ultimately passed most of them down to consumers. And I wouldn't be shocked, by the way, if we would have seen domestic producers like the ones who are competing against these imports, they may have also pushed their prices higher as well because it's like, well, everyone's doing it. They could blame tighter labor markets. They could blame supply chains as well. So you could see prices rising there too, and it'll probably eventually show up in the CPI, and that's what the Fed's going to be watching. And it's going to determine whether or not they're going to have a less dovish or more hawkish tone. That means stronger U.S. dollar, et cetera, et cetera. So, and I'm also very curious, whether or not companies would have been forced to sort of eat up some of these higher costs. But anyway, water under the bridge for now. Uncertainty is obviously a very bad thing.
Indeed, uncertainty is a very bad thing. What about Canada?
Oh, that would have been very bad. If there hadn't been a deal, if Canada didn't get that 30-day break, I think it would have been a lot worse for Canada. We had assumed, you have to make assumptions when you're making forecasts, right? So we had assumed roughly that the tariffs would have lasted like about a year. And before this, we had penciled in roughly just under 2% growth for 2025. So with all these tariffs and assuming they had lasted a year, we would have seen all of that growth erased. A recession, we would not have been able to dismiss the possibility of a recession again because trade with the U.S. is a huge deal. Now, again, Canadian exports, just to repeat some of those factoids that I threw out earlier, 75% of all of our stuff, head to the U.S., which is about 20% of GDP. We would have seen our supply chains disrupted, which of course slowed down, business activity and consumption. But I think one thing still holds is that the heightened uncertainty at that point would have reduced business investment, and I think that still holds because again, businesses are probably wondering what's next, what's going to be the next shoe to fall. And we certainly would have seen lower domestic demand just due to higher prices from all these tariffs and, of course, a weaker dollar. And Canadian inflation would have been, probably about 1 percentage point, maybe a bit less higher than what it is now. Of course, we would have had some buffers for sure. We would have had a weaker Canadian dollar, which is a good thing for exporters. We would have had lower interest rates. Thank you, Governor Macklem. We would have had some fiscal support because Ottawa was already ready to step in. with some government relief programs, for jobless workers and affected businesses. But these supports, would have assumed with this is assuming that tariffs would have been revoked after like a year or so. So we would have expected a modest recovery next year. But again, well, everything is sort of, we'll have to see how things go. But it would have also had big implications on a sectoral basis, again, especially from the motor vehicles sector, the auto parts sector, iron and steel, aluminum. Our agriculture sector would have been impacted a lot as well. Oil industry, um, housing market recovery, which we had been expecting this year, would have been on ice, and by then it would have recovered probably next year as interest rates come down. So yeah, but of course that's all looking backwards, so now we just look for slower growth. We're looking for slower growth than before this weekend, just on heightened anxiety. Um, but meantime, still think it's going to hold back on all these things that I was mentioning, like business investment and certainly capital inflows. But there was definitely, I think, long-term damage. I think that we're going to see um, inflicted on Canada's economy.
Now, on the US side, a lot of people are wondering about the implication of deportation efforts. What should we be watching for in the short term, and what industries will feel the effects the hardest?
Okay, so it's a great question, and plus we're going to be getting our great payrolls report, the very closely watched payrolls report on Friday. So the labor market right now is broadly speaking still very tight. 4.1% unemployment rate is still historically low. So I would be watching all the job surveys, not just one, because a bunch of them have different survey responses, and some of them are lower now. But just watching to make sure that they're all pointing in the same direction. Um, I'd be watching food costs as well, like so that the sectors that are going to be impacted the most, I think, would be the agricultural sector because 50% of workers on American farms are undocumented workers. So if you imagine that all of those people are now unable to work, so you're hiring legal workers and they're going to be demanding a lot more in terms of wages and benefits and all that. Construction industry is another one that's also very highly reliant on undocumented workers. And California, for example, is one state that's going to be needing a lot of massive rebuilding. So, and I should also mention that even though those are the two big sectors, that I can think of, again, agriculture and construction, but there's also like legal workers, those on like H-1B visas. Apparently, there's a big run of like literally running to the lawyers after the inauguration to say make sure that they are covered and they are okay to stay in the U.S. Of course, there's going to be impact on money, on wages, and benefits, and so you would have to watch those sorts of things as well because they can be inflationary. And that's just the short-term things that I'd be watching.
Okay, and so what about the long term implications of the deportation efforts? What indicators should
Um,
people keep an eye on?
I'd still be watching wages, for sure. Just and then you'll have to see how, it's easy how sticky prices are going to be. Companies are going to be paying out more for wages, for benefits, for training, that sort of stuff. And then again, all this could eventually spill over into inflation. So there could be an implication on CPI in terms of stickiness. Um, we should also mention, by the way, just not inflationary related, but even though these undocumented workers were not paying income tax, they're still paying into the system, right? They're still paying sales taxes and property taxes. So that means potentially less revenue for the federal government. Um, I can also think about things like, whether or not um, trade relationships, whether or not they can be mended. But in terms of the labor force itself, like even before lately, over the last year or so, you've been seeing this like divergence. I'm going to use my hand signs here. You know, more rapidly growing foreign-born labor force population, whereas the domestic-born labor force the growth is starting to slow. So this is going to cause that, I think that that spread to continue to widen. And it's not as if and this is where it gets a little bit on the scarier side. And it's not as if we're adding to the pool of workers either. Just looking at fertility rates, for example, U.S. fertility rates hit an historic low last year of 1.6, and the magic number, by the way, is 2.1, and that is by definition the number of children that a couple would have to have over the course of their reproductive years to replace themselves. So it's 2.1, and right now the U.S. fertility rate is 1.6. So that's really, really low. At the same time, and this is a fact that I love to parade about. 4.1 million Americans last year hit that magic age of 65, and they were calling it the silver tsunami or peak 65, and that's going to continue happening over the next couple of years. So that is, I think, is going to be one of the longer term, things that the unintended consequences I think of these deportation efforts.
So when we reflect over the last couple of months, does anything really shock you? President Trump said a lot during the campaign. Um, what this brought up, is this something we need to get used to?
I think we have to get used to the shock factor. I think I was more surprised, more like wow, that how quickly and efficiently he got to work. Dealing with the deportations, the borders, and the tariff threats. I wasn't particularly. Um, um, I was a bit surprised, I think, with the tone of his speech at the World Economic Forum. Basically threatening all countries to bring your production into the U.S. or you're going to be facing tariffs. So I think we should be prepared for some follow through.
Oh, okay. So understanding this is still early, but what does this mean for global growth?
So the fact that the tariffs have been tabled for now, at least for the next 30 days, I think that that is helpful. But that's still a risk out there. But we all know that tariffs are a bad thing. It may be good temporarily for national security, dealing with unfair trade practices. But again, only if they're temporary. But they have a lot of negative consequences, and it's definitely inflationary. And of course, all of this is coming at a bad time. It always comes at a bad time. There's no good time for tariffs. But when you're looking at places like China, who is now the only recipient of these tariffs from the U.S. And they're already dealing with a lot of their own issues domestically, with a very weak property sector. Demographic front, they've got, was a record low birth rate, the highest death rate since 1974. They actually raised the retirement age as well. So they're dealing with a lot of issues domestically, and now they're dealing with all of this as well. So, and of course, Europe, little political infighting, as I mentioned earlier, with Germany. So it's very difficult when you've got all this political infighting to get anything done. So, my one hope, I guess, is that, for Germany, as an example, that the new government will release the debt brake, which would be very, very helpful, I think, for Germany.
So what's Powell going to do, and the Bank of Canada?
Oh, I don't know. So Fetcher Powell, by the way, I believe he said he was going to be doing his semi-annual testimony on February 11th. So it's a week from today. So right now we sort of expect that the Fed will sort of stay on hold until mid-year. That was we haven't changed that call at all. At the last meeting, Fed Chair Powell did say that they are in no real hurry or no rush to tighten policy, or sorry, to ease policy anymore. Going to sort of sit and wait, and we'll see how the data play out. And there's going to be some messiness and some noisiness, I think, in the data, depending again what happens with tariffs over the next month or so, if anything does happen. But right now we have the Fed on hold until mid-year, lowering rates till just over 3% by middle second half of 2026. Bank of Canada, we are going back to where we were before the weekend happened. So we look for 2 more rate cuts. By the way, they have been easing so aggressively already. I don't know how much more they need to do. So we have the Bank of Canada rate going down to 2.5% by October of this year, and then stop. But of course, everything is data dependent, meeting by meeting. I love to quote that, but that's how we see things right now playing out.
Well, thanks on that, Jennifer. And I'm going to give you a little time to, to catch a breath. And we're going to be speaking about the U.S. dollar. Stephanie, can you walk us through your views on the currency front? How are you guiding our customers through this?
Thanks, Dean, and thanks for having me this afternoon. When you look at currencies, we really need to see how this all plays out before we can get a clearer picture of the future. What we do know is that the trade war has large implications for the FX market, and this was never more evident than yesterday when we saw dollar CAD and dollar MEX completely whipsaw in the news, the tariffs being announced and then quickly delayed. So forecasting the shock from tariffs right now is particularly hard, given there's no precedence for moves of this magnitude, and there are so many questions outstanding. If and when the tariffs will start, how long will they last, what other countries will be targeted, how those countries will retaliate, and so on. So for the time being, increased uncertainty and market volatility will continue to be the key themes. That being said, there's little debate that tariffs will lead to increased consumer prices and inflation in the US, particularly if major trading partners retaliate, and could even delay further interest rate cuts by the Fed. And this comes at a time when core inflation remains elevated, the job market's strong, and consumer spending is solid in the US. So getting back to the US dollar, If we take a look back at last year, let's remember we started the year expecting to see 175 basis points in rate cuts by the Fed as a response to their dual mandate, price stability, and maximum employment. At the time, there were broad expectations that the US was headed for an economic slowdown, and there were concerns about the viability of a soft landing. However, when other central banks started to initiate their easing cycles in March, the Fed remained on the sidelines. And as a result, we saw the US dollar appreciate by about 3% in the first half of the year. So this was in response to the market recalibrating its expectations for both short-term rate cuts and the long-term neutral rate. Then, after a few months of low inflation readings, the Fed finally chose to move forward with rate cuts and kicked it off with a 50 basis point kind of catch-up cut on September 18th, causing the dollar to bottom out. Then as the market started to price in the odds of a Trump presidency, otherwise known as the Trump trade, we saw the dollar take off due to post-election policy prospects for higher tariffs and lower taxes. This resulted in an 8% move up in the dollar index through year-end, all while the Fed cut rates by a total of 100 basis points. So with the Fed rate cuts, with fewer Fed rate cuts, the threat of heavy tariffs, it was understandable to see the US dollar index rally, volatility rise, and nearly every major currency weaken against the dollar in 2024.
So, Stephanie, what is your outlook for the US dollar this year?
Well, Dean, that's a great question. I first have to give a disclaimer that given all this uncertainty, my confidence interval around these views is very wide right now. However, if large-scale tariffs do materialize and are permanent, I would expect to see a significant impact on the currency market, particularly for target countries, and the dollar to remain strong. I think we'll see the stronger dollar weigh on the Canadian dollar, Mexican peso, euro, renminbi, but that could easily extend to most of the G10 while economies adjust to the impact of higher tariffs. However, in the short term, it'll take time for US importers to find new sources of supply, which will kind of cushion the immediate impact of tariffs on foreign economies. I also expect the Fed to proceed cautiously with additional rate cuts, given the potential for even more stubborn inflation. Just at last week's FOMC meeting, it was no surprise the Fed remained on the sidelines and communicated to the market they aren't in any hurry to cut again. They maintain their outlook for rate cuts in 2025, and this was after moving them down from 100 basis points to 50 basis points at the prior meeting. And if we look at market expectations, there's currently only one full rate cut priced in for this year, with about a 70% chance of a second cut, with the Fed not expected to make its next move until at least June, as Jennifer mentioned. So again, we're in a situation where there's a growing divergence between the expected movement by the Fed and most of the rest of the central banking universe. A longer term view is even more difficult to pin down, as we'll need more clarity around trade policies, which are changing daily. If large scale tariffs do move forward, we'll eventually see an upsurge in inflation, slower growth, and the Fed may have no choice but to keep interest rates high, providing continued support to the US dollar. However, if it turns out that the tariffs were in fact a negotiating tactic and are quickly repealed, then I expect to see the Fed resume its rate cuts and the dollar start trending weaker over the course of the year. And on top of all this, we still have the impact of tax cuts and deregulation to consider. So our heads are spinning, and we're only 2 weeks into this new administration.
So I do appreciate your view on the US dollar and what's happening this year. And yes, it certainly is very dynamic and fluid. I think the term that I keep on hearing in the news all the time is a term fluid. So I think that's going to be our word of the year, I think. So what is your outlook? And what are your expectations then for the foreign currencies?
Sure. Well, when we look abroad, we see the dollar index hovering around its 2-year low, with the hardest hit currencies being those that have faced significant tariff threats from the administration. No surprise. So, China, Mexico, Canada. However, other major currencies such as, euro and the pound have not been spared. So after the tariffs were announced this weekend, the Canadian dollar and Mexican peso hit fresh lows, which was no surprise given the announcement. before recovering today to about where they were trading at the end of last week. The peso broke its 3-year low, while the Canadian dollar pushed to its lowest level in 22 years. The weighing on the peso, which is down about 30% since the April high, are also the judicial reforms taking place and a downward trend in inflation that's expected to continue. So I view the risks for both currency pairs to be tilted to the downside under the Trump administration. But as Jennifer mentioned, the irony is that the more their currencies weaken, the better it will be for both Mexico and Canada. So, a permanent 25% tariff on exports to the US risks pushing Mexico and Canada into recessions, but currency weakness also helps to absorb some of that impact. Mexico's central bank actually meets this Thursday, and it's widely expected they'll cut rates due to sluggish economic growth and a decline in inflation. Interestingly, with the exception of the gap lower yesterday, we've actually seen the Chinese renminbi strengthen over the last couple of weeks. So I think this was because the 10% levy announced by Trump was less than the 25% imposed on Canada and Mexico, and significantly less than the 60% he mentioned when he was on the campaign trail. Also, China's reaction to the tariff announcement in terms of retaliatory measures is widely viewed as being largely symbolic at this point and leaving them open to further negotiations. But looking forward, we'll have to see if the current measures escalate into a full-blown trade war with China, and will the US retaliate to China's retaliation? So regardless, I expect Beijing will continue with its commitment to adopt a more proactive fiscal policy and a moderately loose monetary policy in 2025. And this is, China's economy continues to be weighed heavily from a weak job market and the ongoing shock from its housing downturn.
Thanks, Stephanie.
Can I just say something?
Sure.
Please.
Go ahead, Jeff.
Sorry. So apparently, President Xi and President Trump are supposed to be speaking. I don't know when. I thought it was today, but there's going to be some dialogue between the two of them. So who knows? If the trend holds, are they going to be exempt as well from the 10%? So we'll see. Anyway, just wanted to throw that in there. Continue.
Ever changing.
Thank you. Can you provide some additional insight on the Canadian dollar?
Sure, Dean. So prior to this weekend, the Canadian dollar had already been hit particularly hard since the US dollar started its run back in October. Since then, we saw an almost 8% move, largely as a result of the trade uncertainty, and then also the divergence in monetary policy with the US. The Bank of Canada has maintained an aggressive easing cycle, which is likely to continue this year, while the Fed has become much more cautious. So just last week, we saw the Bank of Canada cut rates by 25 basis points to 3%. This was actually its 6th consecutive cut. So with a total reduction of 200 basis points, this makes Bank of Canada the most aggressive cutter in the world this cycle. However, given that Canada's economy has been showing signs of improvement with increased consumer spending and a boost in the housing market, I kind of question whether the bank would have proceeded with this cut had it not been for the threat of tariffs. Also going into this weekend, the Canadian dollar was already the worst performing G10 currency this year, and it's still trading near its lowest level in 2 decades. So looking forward, the tariffs could be a major drag on the economy. They have to be addressed by a looser fiscal monetary policy mix, leading to, further weakness in the currency. So while the market has another 2 cuts priced in by the summer, which is also BMO's base case, I think the risk is really that the bank cuts more than the market expects if faced with a true trade war. So, this was evident yesterday before the tariffs were delayed 30 days when there was talk of an emergency rate cut before the next Bank of Canada meeting in March. So, if a lengthy trade dispute with the US does materialize, I think we could see rates in Canada fall by as much as 150 basis points this year, with dollar CAD making a push towards 150.
Okay. What about the political climate in Canada? again, we're going through a process right now. How will that impact the Canadian dollar?
Yeah, well, the political situation, it's definitely not helping. So with Trudeau's resignation, the Canadian government is still in a standstill till the next prime minister is chosen. Parliament is reconvened, and potentially there's a federal election. So as a result, I expect we'll see quite a bit of movement in the Canadian dollar during this time. But overall, I expect it to remain weak. So if U.S. tariffs end up being rolled back, then we'll likely see some recovery in the Canadian dollar, which could be further supported by domestic political uncertainty and an eventual end to the Bank of Canada's easing cycle. This should help the Canadian dollar recover by year end, but my confidence around this happening right now is pretty low.
So now that we've talked about North America, what about when we look across the pond?
Sure. Well, and Jennifer, feel free to jump in here as well. But while the UK seems to have been spared for now from tariff talks, it sounds like the European Union is Trump's next target. So I wouldn't be surprised to see the euro head to parity this year, as their disinflation story has been more aggressive than ours, and there's more optimism around rate cuts out of the ECB. The central bank cut the deposit rate by 25 basis points last week, and this was as expected. And this was after cutting a total of 100 basis points last year. And the market does expect another 75 basis points for 2025, although the pace of that is debatable. While inflation has moderated, plenty of economic and political uncertainty remains, and many worry that if rates stay too high for too long, inflation could fall below target and economic growth, could remain weak.
By the way, I'm just going to pipe in. So we also have that's been my thing is like I've got the euro hitting parity by March, so we'll see. But yeah, I totally agree with that 75 basis points further cut. So we've got the European deposit rate hitting 2% by the end of this year. But yeah, I think March, it looks like a done deal, almost a done deal, as done as you can possibly get. But after that, there's going to be a lot more room for debate. I think that's what they're saying, a lot more deeper and broader debate on what comes afterwards, because there's still some hawks out there who are afraid of, being too early.
Yep. Thanks, Jennifer. And yeah, and the story is a little different in the UK. I'll just comment on the UK quickly. Given that the US doesn't have a trade deficit, and that's mostly, because their economy is very much, service driven, but also, due to the inflation pressures, they're falling more slowly. As a result, I think the Bank of Canada will proceed more cautiously with rate cuts going forward. That being said, they're also dealing with stagnant growth that will likely support the bank to move forward with a 25 basis point rate cut at their meeting this Thursday. So a primary interest from the announcement will be the number of votes in favor, along with the rationale in support of the cut as we look to guidance for future meetings.
Great. We did receive some questions from our participants in advance, specifically about Japan. Can you talk about the yen?
Sure. So the yen was one of the hardest hit currencies in the back half of last year, with a 13% decline between the September high and the January low. The yen has suffered from a wide interest rate differential with the U.S., while the Bank of Japan remained extremely dovish, despite above target inflation and increasing wages. And that sent the yen to its lowest level since the 90s. However, after finally putting an end to negative rates in March, the bank has been cautiously tightening and is expected to continue on this path in response to the acceleration in core inflation, which has helped the yen recover. So, and also its status as a safe haven currency, has provided support to the yen as well when markets are trading in risk-off mode. So Japan now stands alone. It's the only major economy where the central bank is expected to raise interest rates in 2025. So, I think we could see some, appreciation there.
It's a long time coming.
Sure is.
With so much uncertainty, What strategies are you seeing clients use to manage this risk?
Well, good question, Dean. I think on the whole, we're seeing clients be more proactive in managing their FX and interest rate risk and kind of rethinking their risk management strategies. So I like to think of risk management as really kind of a spectrum of different approaches and then the related tools. So for example, companies that never hedged previously are now looking at implementing hedging programs, and companies that used basic hedging structures like forwards or swaps are looking into more structured solutions such as options or going further out in tenor. So what has become clear is that companies are preparing for ongoing volatility and long-term uncertainty and taking a more thoughtful approach to risk management. What I found really interesting was what we saw back in October, when we had over the course of the month a sharp 7.5% move higher in the dollar index due to that Trump trade. For many companies that were unhedged, this move exposed a weakness in the structure of their FX exposure in cases where they didn't have an active risk management program in place. So all of a sudden, companies that chose not to hedge because they didn't feel currency risk had a meaningful impact on their business were caught kind of flat-footed and scrambling to get set up to trade. In addition, companies that use basic FX forward and interest rate swap structures started looking more extensively into option strategies that allow them to obtain protection from adverse moves while also giving them the ability to benefit from an advantageous move in the market. So, this has been particularly common in the rates market, where we've seen increased interest in collars, given the uncertain outlook, and some clients looking for the ability to participate in a downward rate environment while also locking in protection from a potential move higher, which is not entirely out of the question right now. Also, during periods when future currency movements are unclear, options can help firms kind of navigate short-term volatility without committing to fixed positions. So essentially, wherever clients kind of fall on this risk management spectrum, I think now's a great time to take another look at the approach and think about incorporating changes that could result in better outcomes.
Thanks, Stephanie. This certainly seems complicated. From my view, is this something your team is able to help with?
Yeah, of course. Our team is here to assist in that analysis and advise companies on structures, that could be appropriate and that will align with, their stated goals and risk tolerance. So, clients should feel free to ask their RMs for an introduction to our team. They're dedicated FX and rates specialists.
Excellent. Let them know that you're their support. Are there any best practices that you can share from your work with clients?
Sure, Dean. So, my biggest piece of advice right now is to do something. So this isn't the type of market where you want to be sitting on the sidelines waiting to see what happens, because before you know it, you'll be on the wrong side of the market, wishing you would have been more proactive. That doesn't necessarily mean companies need to start, placing hedges on 100% of their, forecasted FX exposures or locking in the rate on 100% of their outstanding floating rate debt. But they should at least be looking to take some portion of that risk off the table. So maybe rather than hedging 80 to 100% of their FX exposure, they're hedging 50 to 75%, or they're targeting a 50-50 fixed floating rate debt mix as a start. Or maybe they consider using a layered approach to hedges, start small and average into a position over time to get kind of more of a blended market rate. These are just examples, and the ratios, of course, should be tailored to meet each company's specific needs. But the key point here is, not to leave the company entirely exposed to an adverse impact on profitability that it could have otherwise been contained. Furthermore, for companies that haven't hedged in the past, I always recommend they put in place a risk management policy. It's a document that outlines the objectives of the hedging program, identifies the exposures, the strategies, that are to be used, along with the risk tolerance, and have that signed off by senior leadership. I can't stress the importance of this enough, is it acts as kind of a blueprint, if you will, to managing risk and ensures the company is working to achieve its stated long-term goals, not taking speculative positions in the market. And finally, I think consistency is key. So all too often, I see companies take a knee-jerk pause in their hedging programs when they're in a negative mark-to-market position, only to miss out on opportunities to lock in at a time when the market's most favorable to them. So it's important to remember that, hedging's a long-term strategy and should not be driven by short-term noise. Particularly in this kind of environment with such high levels of uncertainty, a consistent approach will help ensure the overall effectiveness of the company's risk management program.
Thank you, Stephanie, and certainly appreciate all the the work and the guidance you have provided to us. And I'm glad we brought back Jennifer. What I would like to do is maybe, and we only have about 5 to 6 minutes, is maybe summarize each of you your 3 key takeaways, and maybe I'll start with you, Jennifer, to give Stephanie a little opportunity to catch her breath.
Okay. I'm going to state the obvious, to expect the unexpected. And I think I said that earlier.
I think that's an important one, again, to expect the unexpected. Also, and I think back to the last, when the last time, we had Donald Trump in the Oval Office, he put out a lot of tariffs on, $300 billion worth of goods, and especially in China. And I think people were expecting that to go away once President Biden took over, but that didn't. And in fact, the President Biden then took those tariffs and kind of ran with them and put more tariffs on China. So I think this whole protectionist sentiment, I don't think we can expect things to change from one administration to the next. So that's my takeaway. And as well, one concern I have is that with all of this happening, we've been using the word resilient a lot over the last few years. U.S. economy being very, very resilient, and I'm just a little bit concerned that that even though right now the economy is in very good shape, that resilience is going to be fading in the next year or two.
Thank you, Jennifer. How about you, Stephanie?
Yeah. So my first takeaway is as Jennifer said, plan for continued high levels of uncertainty and market volatility. So, we view the uncertainty tax related to the outcome of the tariffs announced this weekend and the tariffs being implemented more broadly is very high right now. And as we're only 2 weeks into this new administration, we know there's plenty more policy changes to come. Second, I'll remind everyone that, risk management is key. So with all of these risks on the table, why not control the risks that you can through the use of FX and interest rate hedging? Being strategic, having clear goals in mind, and maintaining consistency will help companies obtain the desired results with that program. And then finally, I think now is a great time to reassess and look at hedging strategies that could result in better outcomes. In light of the current market environment, I encourage companies to take another look at their hedging strategies and consider making adjustments to the ratio of cash flows hedged, tenors, and possibly including option structures in their risk management toolbox. And of course, as I said before, our structuring team is here and happy to support our companies and our clients' efforts.
Thanks, Stephanie. And if you wouldn't mind indulging me, I do have a couple of items that I like to discuss, or at least promote. Is we really have to. I think this is a time right now to really look at our supply chains. Where are we? Maybe potentially looking at diversifying it. And I'm not talking from both a Canadian and EU perspective, and look at what markets are acceptable to them. Second one is, you really do have to work with your bank or your partners. And again, it's not just your bank, but also working with government agencies. Make sure you stay on top of things and try to influence. And the third thing is also on industry associations. They're certainly great advocates, and they advocate for this particular businesses. And I think that is something that we have to continue doing. So again, I appreciate, and I want to thank you, Jennifer and Stephanie, for a timely and informative discussion and allowing me to ride along the roller coaster with both of you. And thank everyone for joining us today. As a follow-up, you will receive an email from BMO with a link to a survey about the session, as well as a letter for your CTB credits. Additionally, we'll provide a link to a replay of this webinar. We do encourage you to share with your teams and colleagues who have missed it. Lastly, this is a fluid situation. Again, I'm using the word fluid, and changes are happening quickly, as signaled by the U.S. administration. We suggest reaching out to your relationship bankers for continued updates and guidance. And with that, have a great rest of your day. Thank you.